All right, good morning, everyone. The time we scheduled to start the meeting was 9:30. However, because of the turnout, we're just waiting for a few more people to join us, both virtually and in person. So kindly give us a few minutes, let's say 5 minutes, then we can begin the program. All right, thank you. Hello again. Just a quick one. We're still expecting a few more people to be here with us. We'll start exactly at 9:50. At 9:50, we'll begin. So this goes to those online and those who are also here with us presently. But in the meantime, those who are here, you can have a go at the few fruits and other servings at the table just behind us, just so we can make up the time. All right. Thank you.
Come to smoke cannabis. Doctor say make a pop one of this. Make me fly like say I'm Aladdin. Come bring some kind melodies. Oh mama myself no do pass like this. So many things inside of my jeans. Slide down DBTs.
Okay, kindly forgive us for the late start. We have a few minutes to 10, 2 minutes to 10. I indulge that we begin at 10 instead. In the meantime, still the breakfast items are behind. Kindly feel free to enjoy those while we wait to start at 10. Thank you. Good morning to you all once again. Thank you so much for your patience. As always, it's a pleasure to see you all, those who are here with us in person and those who have joined us virtually. It's been weeks of preparation, sending emails, sending reminders, and the day is finally here. And we are honored to have all of you. We see a lot of balance sheets sitting with us here. As you may know, this is our maiden CFO Connect session, and we are hoping that this event turns out to be as impactful as we have planned it to be. We are delighted that despite your busy schedules, you have made the time, you found the time to join us on this day. My name is Ebenezer Amwaku. I'm an assistant manager with the Technical Advisory Services line with Accountant Advisory Service in KPMG Ghana, and I'll be your host, or you can say MC. Today's session is focused on, we've had to wait for a long time for this, so today's session is going to focus on IFRS 18, and what this is going to achieve is that we want to tickle your minds. We want to also bring to bear what IFRS 18 is coming with. We want to see how businesses would navigate this new standard. We also want to get you thinking about the impact it will have on, say, your financial reporting, your business processes, systems, if you may add, and others. So, of course, we'll also add how KPMG can assist you in the implementation journey. So welcome once again to this event. On the lineup for today, we would first of all introduce ourselves, not individually, but as I have done already. We would also then have an official keynote start, so more like the welcome address, and that will be given by our partner, Randolph Ano. I'm sure many of you in the audience know him by name, if not by heart. By way of agenda, right after that, we would have an overview of the standard, taking us through the journey that IFRS 18 has had to go through till date. We'll discuss things like when the standard is meant to take effect and all that. We'll see the impact as it will have on tax implications, systems, processes, as I've mentioned already. We will then also have someone come in from our UK office by the name of Manisha. She would talk us through some of the challenges that businesses are facing today, talk about the experiences so far. And I'm sure that session you would really enjoy because you would like to draw comparisons as to what you yourself are facing or expect to face as you implement the standard. We would have a Q&A session. So as we go ahead, kindly jot your questions down. We'll have a session for that so that we can share experiences and share knowledge. We would also get opportunity to talk to each other after the program. We would have a short break. We would also have some time to, fill the tank, as many of us may not have been, filled in the morning as we're getting here. So to get the ball rolling, we would invite our partner, Randolph Ano, to give us the welcome address.
All right, thank you, Ebenezer. And I see that you've already closed the session. You are thinking of the weekend, so the good night was in order. All right. Good morning, distinguished CFOs and finance leaders. I warmly welcome you to today's CFO Connect. We know how busy the office of the CFO is, and so we don't take it lightly at all for you to make time to join us here today. We see a lot of changes happening now as far as finance function is concerned. Now emerging techs, AI, and the rest are transforming the way we work. Sustainability is now becoming very integral in all that we do. We continuously also see more standards coming, and that is not going to change. That will continue. So for us from KPMG, we decided to organize this Connect session, and this will not be the last, where we want to discuss key and strategic issues impacting the finance function. And of course, discuss how we can collectively address some of these issues. So today, as Ebenezer had indicated, we want to focus on IFRS 18. IFRS 18 is bringing a change, especially in the way we report our financial performance. We usually say, or it is said, that accounting is the language of business, and it is. But I like the way Warren Buffett puts it. He says, accounting is the language of business, but to understand it, that language, you need to know, I'm just paraphrasing, the numbers, the meaning of the numbers. And so IFRS 18 is going to accelerate this, to speak this language clearly, and to make our stakeholders, the investors, and the board, and all the other people we report to, bring some consistency and some comparability. We already are applying the accounting standards, and so there is some comparability, but when it comes to financial reporting, investors, there are some judgment and differences. So this is going to bring some rigor in the way things are done. For us, we don't want you to see this as just a standard that you want to adopt, but there needs to be a rethink of your processes, your systems, your people, and how you effectively do this. So as finance leaders here, the question to you is, how ready are you? And if we unpack the how ready are your systems able to support you to generate or comply with the requirement of IFRS 18? Are your processes able to help you to comply with the requirement of IFRS 18? What capabilities do you need to build as a finance function to effectively adopt this new standard? These are things that you need to think about. It's an opportunity for us in finance to explore and deepen the way we communicate our financial performance to our stakeholders. So, thank you once again for joining the CFO Connect today. We ask that you participate fully, for those of you online and those also in person. Welcome once again. Enjoy the session.
Thank you very much, Randolph. Indeed, we are hoping to have a very fruitful session today, and we'll be all ears. Next on the lineup, we have the overview of IFRS 18. And this part will be handled by our senior manager by the name Sharon Akwe. She has many years experience in the technical advisory space, and she would like to share with you this part. So join me as we welcome Sharon Akwe to expand on IFRS 18 overview. Thank you.
Good morning, everyone, and thank you, Ebenezer, for the introduction. So I'll be taking us through the first session for today, giving you an overview on IFRS 18, the presentation and disclosure in financial statements, with a focus on why the standard came into being, and then the key changes that we should be looking out for in the standard. Okay, so as we move on, before we start the session, I would like us to do a very quick knowledge check. So if you have your phones out, please ask that you bring it out and scan the QR code. It will give you 2 quick questions that we would require you to respond to. think we can use about a minute to do that. Then we proceed to look at what the responses are. Okay. So the first question, which is a true or false question, IFRS 18 changes how income and expenses are presented and classified, but does not change how they are measured. Everybody who has responded correctly and said that that is true. And it's actually true. So IFRS 18 is a presentation and disclosure standard, not a measurement standard. And so it doesn't change how we recognize transactions in our financial statements. Okay, there's also a second question. It looks like we didn't get any response from this. It was too quick. Okay. So the question was, which of the following best describes management's performance measures under IFRS 18? If you don't know it, we would run through that. But the answer is A. Okay, the answer for this is A. It's a metrics that management uses to communicate performance, which are not IFRS defined subtotals, but are included in public communications and reconciled to IFRS 18 figures. Okay, but would you get a better understanding on that as we proceed with the presentation? Okay, so I'll start by taking us through why there was a need for the standard. Okay, the International Accounting Standards Board published IFRS 18 to improve the quality of information communicated in the financial statements as a direct response to concerns raised by investors. Okay, so investors, when they needed to compare between different companies, raised a number of concerns, and I'll take us through what those concerns are and why the need for the standard. So one of the concerns were that the income statement varied in the structure and contents, which made it difficult for them to compare between each other to help them take informed decisions in their investments. And then also they found that non-GAAP measures, which help them explain unique circumstances in their financial statements of companies, were very useful. However, because it wasn't mandatory in the notes of the financial statements, it wasn't consistent. A particular company would probably indicate this, another company would not, but investors found that it was very useful to help them take informed decisions. Okay, so they felt that it would be good to have that as a mandatory standard. And then they also felt the need to provide more granular information and group information in a way that would provide better inputs for analysis. So these were the main reasons why the IASB thought it wise, listened to investors, and thought it wise to bring in the IAS 18 standard. Now we'll move on to have a look at the overview of IFRS 18. In the overview, there are three key things that I would like you to take note of. The first one is that IFRS 18 presentation and disclosure in financial statements will replace IAS 1, which is the presentation of financial statements. But then many of the principles that we had under IAS 1 will still be maintained. So principles such as recording transactions using accrual basis, ensuring that your financial statements are comparable year on year, is still going to be maintained, in addition to all other principles that we had under IAS 1. The second thing that you need to take note of is that the standard does not impact recognition and measurement of transactions. So if you should pick, let's take for example an income statement presented using IAS 1, and then an income statement presented using IFRS 18, and compare the net profit for a particular period. The net profit shouldn't change, it should still be the same. It's just the presentation that you'd see differences in. So in terms of classification. And then it's effective year 2027, from 1st January 2027. However, early adoption is permitted. And so this is the time from now till the end of next year to prepare towards this new standard and make sure that you are ready for conversion on 1st January 2027. Okay, so what are the key changes? No, please go back. What are the key changes? One, we are looking at a more structured income statement, okay, to ease the comparability of financial statements. So out of the primary financial statements that we have, your statement of financial position, statement of financial performance, which some call the income statements, statements of changes in equity, and the cash flow statements. It's the income statements that has major changes, and so we'll look at that in more detail as we go through the slide. There's also an introduction of a new disclosure called Management Defined Performance Measures, and there are also enhanced requirements on aggregation and disaggregation of information. As we move through the slides, we would have a better understanding of all this. Okay, so what do we mean by a more structured income statement? On the screen, I have shown an illustrative income statement using IFRS 18, and it's totally different from what you might be used to under IAS 1. But there are some key changes that I would like us to run through. The first one is the fact that income and expenses will now be categorized in 3 main areas. So we have the operating category, the investing category, and then the financing category. Under the operating category, you should include all income and expenses from your main business activities. Okay, and it's also called the default category, such that if you have any income or expense that you are not able to tell whether it's supposed to be under the investing or financing category, and it's also not part of your core operations, you can record or classify those transactions also under the operating category. There's one thing that I would like all of us to take note of as I move on, and that is specified main business activities. And these are primarily defined as activities in relation to businesses that invest in assets and also provide financing to customers as their core operations. For instance, you have banks, you have investment companies, insurance companies. For these entities, due to the nature of their businesses, certain income and expenses, which ordinarily you would have classified under investing or financing, would have to be classified under the operating category, because in fact, that is your main business activity. Okay, so I'd like you to take note of that as we go on. Moving on, the second category is the investing category. And in this category, you would have to record or classify all income and expenses from all investments that you have, including if you have investments in associates or joint ventures using the equity method, that would have to be classified under the investing category. Also, investments in cash and cash equivalents, rentals rental income from investment properties, all these would have to be under the investing category, with the exception of if you have these transactions or activities as your core business operations. Okay, so that means that you have a specified main business activity. With that, then you'd have to classify those transactions under the operating category. The third category is the financing category, which relates to income and expenses from financial liabilities. So you would have your interest on loans and borrowings. Also, if you have employee benefits, And after your usual calculations, there's an interest expense on the defined benefit plans. You'd classify that under the financing category, with the exception of, then again, the banks who would have certain transactions as their core operations. So they would have to classify that as under the operating category. So these are the three key categories that I'd like you to take note of at this point. There are also two new subtotals. If you can see in pink, I don't have a pointer, but just bear with me. In pink, there are two subtotals. We have the operating profit, which is profit or loss. So it's an operating profit or loss, okay, which is income and expenses in the total of your income and expenses from your operating category. And then we also have the profit or loss before financing and income tax, which is your first subtotal. That's your operating profit or loss, and all activities from your investing category. Aside that, you would have your usual profit before tax. You can take out the, yeah, okay. So aside that, you have your usual profit before tax, your income tax, and then your profit or loss for the year. Okay, so basically, these are the key introductions to the income statement. Would go on to do a comparison between an illustrative income statement using IAS 1 and then one using IFRS 18. I know you're familiar with the one under IAS 1, even though that's very simple. Your income statements would probably be more complicated than this, but would use this to just give some information on possible changes that you should be expecting when you compare income statements from IAS 1 and then an income statement from IFRS 18. So one thing that you should note is, or the first possible change that you should note is that if you have net interest on defined benefit liabilities under IAS 1, in your income on your income statement, you would have had that net interest classified as part of your operating profit or loss, probably under your general and administrative expenses. However, under IFRS 18, you would have that classified under the financing category, okay, because these are liabilities to your staff. Also, if you have income and expenses from associates, investments in associates and joint ventures, under IAS 1, you would have had that as a line item under your operating profit or loss. However, under IFRS 18, you would have that shown as a separate line, but in the investing category. And then if you have gain or loss from disposal of investment properties, this would be classified under your investing category. However, under IAS 1, it would have still been part of your operating profits for the year. And then also interest income on cash and cash equivalents. Under IAS 1, you would have had that under finance costs or income, which is usually shown below your operating profit or loss. But under IFRS 18, you'd have that shown as part of your investing category. So basically, these are some of the possible changes in classification that you should be seeing with the introduction of IFRS 18. The whole idea is to first of all outline what your core operations are, and then have all the income and expenses from that classified as part of your operating category, okay? And then you'd look out for the other income and expenses, try to identify whether they came in from financing or from investments, and then classify those also accordingly, according to whether it was financing, so that means it would be in the financing category, and then if it was from an investment, you would classify that as part of your investing category. So that's one thing I'd like you to keep at the back of your minds as we go on. Okay. I also made mention of specified main business activities, and I would like to use this illustration to quickly run you through, give you an example. Okay, so I have about 6 companies listed, a manufacturing company, manufacturer A, that is into manufacturing of and sale of goods. We have manufacturer B, who is into manufacturing and sale of goods, but also provides financing to customers. We have a retail bank who provides financing to customers, a retail and investment bank, an insurance company, an investment property company, and then an investment entity. So for instance, if there's a transaction of interest income on cash and cash equivalent, manufacturer A, whose core operations is into the manufacturing and sale of goods, would have this transaction classified as an investing in their investing category. Okay. However, manufacturer B, who aside the sale of goods, manufacturing and sale of goods, also provides financing to customers, would have this transaction as part of their operating category, because the interest income on the cash and cash equivalents actually came from the financing that they provide to customers as part of their core operations. Okay. The retail bank ordinarily deals in financing to customers, so would have that under the operating category. A retail and investment bank, also same, would have that particular activity as part of operating. An insurance company would also have it as part of operating category. An investment property company, who ordinarily is into investing in non-financial assets, would have that as part of their investing category, because interest and income and cash equivalent is not their core operations. And then an investment entity would also have that classified as part of their investing category. We are, due to the time, I wouldn't go through the entire thing, but this is just to give you an idea of what happens when we make reference to the specified main business activity. So it's the same transaction, however, because of the nature of each of the companies listed there, they had to classify the same transaction in different categories. Okay. So I'll quickly move on to touch on management-defined performance measures, which is a new disclosure, and it will be presented in the notes of the financial statements. So these are mainly metrics, okay? So it's a metrics that management uses to communicate performance. And these metrics, they are not IFRS defined subtotals. So the subtotals on the income statements that I spoke about, operating profit or loss, and profit or loss before finance and income tax, those are IFRS specific subtotals. So the first thing that I need to take note of under the managed defined performance measures is that whatever metrics that you are looking at shouldn't be a subtotal that is required by IFRS, and you've already shown that on your financial statements. Okay. The other thing is that it should be a metric that you intend to communicates publicly for stakeholder use. And it also communicates management's view of an aspect of the financial performance of the company as a whole. So for instance, you can have an adjusted operating profit. You have your operating profit or loss shown on your income statement, but you can decide to have an adjusted operating profit or loss, okay, which you are using to explain an unusual expense or something that happened within a particular year, but then you are not expecting that to happen for several years to come. So for instance, in a particular year, you might have had an impairment loss or had some restructuring costs, okay, which impacted your profit or loss for that particular year. You can have an MPM showing your adjusted profits or loss, okay, and then you would use that to explain the unusual transaction that occurred in that particular year that impacted your profit or loss for the year. The other thing that you have to do is that in the notes, once you have your adjusted profit, you would have to reconcile it back to a known IFRS subtotal. So your adjusted profits, probably there was a reconstruction cost, you bring that, do a reconciliation back to what you have on your income statements, and this should be shown in the notes of your financial statements. So companies need to identify, you need to take your time and identify what your MPMs are, and then disclose that accordingly. If you identify an MPM, you need to, as I've said, include additional disclosure in the notes. In the disclosure, you would have to describe what the MPM is, also why it's useful information and how you calculated it. And then again, reconcile it back to a subtotal that you have on your income statement. One thing that you need to take note of is that your MPM is subject to audit by external auditors. So if you have an MPM, when the external auditors come in, they would request to see additional information on what you have indicated as your MPM. I would also like to touch on enhanced requirements on aggregation and disaggregation. This actually is something that is in IAS 1, but there's a bit of enhancement to the requirement. So entities now need to present analysis of your operating expenses. So your operating expenses, you could have that presented by nature. So if you say by nature, probably depreciation, you categorize them under depreciation, staff cost, impairments, loss, etc. Some also used by function. Okay, so with that, cost of sale, distribution expenses, general and administrative expenses, etc., or a mix. So you could have your operating expenses shown by nature, by function, or have a mix of it. What IFRS 18 is requiring that if you decide to show your operating expenses by function, you need to disclose in the notes information about the nature of each expense. Okay, and there should be further disclosure to break down the total amount into the amount that is from your core operations and the amount that is not from your core operations. Okay, however, if you choose to disclose your operating expenses as by nature, there's no additional breakdown that you need to do in your notes. Also, transactions need to be aggregated based on shared characteristics, and then also disaggregated if there are no shared characteristics. And IFRS 18 is also frowning on the use of other. So currently, a lot of companies, you'd have a line called other expenses, miscellaneous expenses, and all that. IFRS 18 doesn't require us to have that. We cannot use miscellaneous and other anymore. We need to specifically define or have specific names for transactions that we have in our financial statements. I can see a lot of excitement in the room because I'm sure we have this. It's a common thing that we all do, but IFRS 18 is frowning on this, so I'd like all of us to take note of that and make sure that we give our transaction-specific labels that can be explained. Okay, so this is to summarize the overview of IFRS 18. We have Manisha, who is from KPMG UK. In the UK and other countries, they have already started started their journey to implement the IFRS 18. Okay, so we have her to come on, also share her experience as she's assisting various clients on this journey, and then also share some of the potential considerations and practical challenges that companies are currently experiencing and how this is being addressed. Okay, so I'll hand over now to Manisha. She's joining virtually. And so I think the team would try to get her on.
I can start in the meantime while the video is being put on. That's...
Hi, Manisha.
Hi, good morning, everyone.
Good morning.
Can you hear me all right?
Yes, we can hear you. However, we can't see you. I don't know if you have a plan to project. You can see her. But how about here? Okay, so I think those on the virtual call can see, but in the room we cannot see. But the team should be sorting that out. So come. If we are fine, we would start. They'll sort it out for her video to come up shortly. Okay, so that's it. Okay, so Manisha, I think we are good to go.
Great. Thank you. Good morning, everyone. So very pleased to be with you today. I sit in the accounting advisory services team in the UK, and over the last 1.5 years, I think it's fair to say, I've been focusing on IFRS 18, and I'm leading our proposition in the UK. So just a bit of sharing my experience. So when I started looking at the IFRS 18, I thought, this looks pretty simple. It's not changing net profit. It's just moving income and expenses across different categories. But then when I started thinking and assessing, how do I apply these requirements? It didn't look straightforward at all. And I could clearly see from the very start various application challenges, practical considerations when looking at certain IFRS 18 requirements. And then what's also clear to me is that, yes, IFRS 18 will change the way information is presented across your financial statements, but it doesn't stop there. It also has wider business impacts. I think the team will touch on some of these, but one of the things we are seeing is that in many cases, companies do not have the data to be able to get ready for IFRS 18. So they are having to go and change the process, the controls, the group reporting pack, the chart of accounts or systems to be able to get the data. So to sum it up, there's a lot to do to get ready. Sharon mentioned earlier that it is effective for accounting periods beginning on or after 1st January 2027, but also comparatives need to be restated. So if comparatives need to be restated, ideally, if you haven't started an impact assessment, I would say start now, because as I mentioned, understanding what the impacts can take some time, can be challenging. And then ideally, you would want to have those changes in place so that you start capturing what IFRS 18 would look like for your comparative period. So as Sharon mentioned, in the UK, we've been working on a number of assignments. Most of my time is spent helping clients with IFRS 18. So working on understanding what are the impacts for them. So what I will do is share some of the practical challenges that may be relevant for you. And then I will finish off in terms of saying where do you take it from next from here. So I focus on corporates. These challenges are focused on corporates, but some of them are also relevant for banking and insurance. But once I've covered some of these, I will give an overview of what we are finding in respect of our insurance clients and banking clients as well. So maybe touch on some of the points on the slide. So the first one, reflecting adjusted measure of income statement. So we are seeing in the UK, and I presume in Nigeria as well, there are a number of companies that present adjusted measures on the face of income statement. And some of them do it like a free column approach with an adjustment column in the middle. Some others do it as boxes, or others are the adjusted measures as subtotals on the income statement. And one of the questions we've been getting is that allowed? So IFRS 18 doesn't prohibit it, but you have to meet specific criteria to be able to continue to present what you do. One of the key criteria in there is that those measures have to be measured and recognized in terms of IFRS 18. So an example, I have a client that has equity accounted investee, but in the income statement wants to present a measure in a way to show some of the income and some of the expense of the equity accounted investee. So it has an adjusted measure that brings only some of the income and expense of the adjusted investee. So that's not measured in accordance with IFRS. Because under IFRS, you would just disclose your share of profit and loss of the equity accounted JV. So that wouldn't be allowed. Another example, a company that doesn't apply hedge accounting, but was to present the results so that it shows that if it were to apply, what it would be. Again, given they don't apply hedge accounting, these wouldn't be measured and recognized under IFRS. They wouldn't be able to do it under IFRS 18. And then staying on the theme of the income statement, Sharon briefly touched on it. So aggregation is aggregation. There's more emphasis in terms of the information that's being disclosed. So currently under IAS 1, a number of companies in the income statement has one line, operating expenses. That will no longer be allowed. They would have to assess whether it's function, nature, function. So for example, cost of sales, administrative expenses, nature, for example, employee cost, or a mix of those. So there's some work that would be needed there. I won't touch on the specified main business activities a lot. Sharon has shared some of examples earlier, but this is the standards provide some indicators to help companies assess if they have a specified main business activity. So for some of them, it would be obvious, like a bank. It's obvious. But if you have your normal trading corporate, but you have something that you do on the side and you have to assess whether that's a specified main business activity for you. So an example would be if a retailer has a banking arm, they would need to assess whether that banking arm is a specified main business activity. And it can get more complicated if you have assets that you're specifically held just to rent out, but your business is not about renting out. Does that part of a business makes it a specified main business activity? And the complexities arise there is because the standard gives some indicators to help you assess, but how about if those indicators are not present? What else do you need to look for? The third point on the slide there is about categorization of income and expense. Yes, IFRS 18 gave guidance, but do not underestimate the amount of work that's needed to do that. So first of all, just starting with the basic, it all starts with your GL code in terms of your income statement. What we are finding is when companies are going and assessing, okay, what's in my different GL so that I can see where it will be categorized under IFRS 18, they do not have the information to be able to assess that to start with. because the GL code description is unclear. There are lots of things included in there, or we don't know what's included in there. And I think I'm seeing that some work is needed on the GL code description or in many of the projects that I have worked on. So that's just the starting point. So once you have the data, then you start classifying into the various categories. Then there are complexities around where certain items should go. And obviously, that would depend on your business, on the different transactions that you have, but I will just highlight a few there. So questions around how do you deal with interest on penalties on tax, both on the receivable, interest on the receivable and on the payable side as well. Government grant, how do you deal with government grant? If you have fees on revolving credit facilities that you're not planning to use, so you don't have a liability there. Sharon mentioned if you have a liability, then it follows, it goes to the financing category, but you don't have a liability there. Where do those costs go? Bank accounts, if it's IFRS 18 talks about cash and cash equivalents, it goes to investing, but if you have a bank account that moves from positive to negative throughout the year, how do you deal with that? If you have cash pooling arrangements, it can get even more complicated. How many financial instruments are you dealing with? Do you have the right to offset? How do you take it from there on? Assets relating to the investing category. So these are, again, that's just focused on corporates for the time being, but it's cash and cash equivalents, your equity accounted investee, any other investment that you hold in companies, in associates and JV that's not equity accounted for. It's also what they call assets that generate return individually and largely independently. There are complexities in terms of assessing which assets meet that last criteria. The standard doesn't give much guidance. And examples, maybe to bring to light, let's say you're a retailer, you have a shop, you sell clothes. In there, you have some specific equipment that you rent out to a coffee place. That rental income from those equipment or these assets from assets that generate returns individually and independently, not so clear. Another one was a recent example I dealt with, a customer, a sale was made to a customer, but in return, the company received equity in the customer, or in return, there was a loan that gave rise to a loan. How do you deal with the returns from those? Because one could argue it arose as a result of a trading. So is it actually individually and largely independently? So that's a big discussion point there. So first of all, what assets meet that criteria to go into the investing category? And then the second part of it, what income and expense actually relating to those assets that go into the investing category? And not all income and expense would go to investing category. So maybe I'll pick up two examples. Equity accounted JVs. Well, the standard is quite clear. Generally, income and expense from equity accounted JVs would go to investing. But if you are providing services to your JV and you read the nuance in the standard, that's income generated from the JV. That wouldn't go in investing. It will go if let's say you're providing management service, by default, it will go to your operating. Another example, Sharon touched on investment property earlier. So your business is not about holding investment properties. You have a side investment property that you're renting out. And if you pay someone to manage that investment property, that cost, while the income from that rental will go in investing, that cost will not go in investing. It will go into operating. So the nuances of a standard can make it complex, and there's some work needed to really understand what am I doing here, what income and expense I have, and accordingly decide where it should be classified. FX, I won't touch a lot on it. Some of you may be aware that IFRIC, the IFRS Interpretation Committee, has a discussion as to how to treat FX on intercompany balances in consolidated financial statements. There, the issue is those transactions are not there in the consolidated accounts, but the FX still remains. So how do you deal with that? That's currently with the IFRIC It's open for comments until end of November, and likely the next phase is next year. But there are other instances. If you have a lease liability, there's effects on that. Where do you put it? Because the lease liability, only the interest, IFRS 18 says put it in financing. How do you deal with the rest? How do you deal with pension that's in foreign currency? How do you deal with provisions, with trade payables that have extended credit terms? And then risk management, in a nutshell, the complexity are, in a nutshell, what IFRS 18 says, if you have derivatives used to hedge your risk, you put the fair value movement of those derivatives in the same category as the income and expense affected by the risk you're trying to hedge. So if you're hedging your risk on sales, you would put it to operating. If you're hedging your risk on borrowings, you would put it to financing. But there is some where you're applying net hedge. This is, let's say, a company has taken a hedging instrument to hedge offsetting FX position that relates to income and expense classified across different categories. So this is a forward contract to hedge my foreign exchange exposure on my cash, which would have been investing, on my borrowing, which would have been financing, on my sales, which would have been operating. IFRS 18 says you can't split it into the different categories because you have taken one instrument to hedge offsetting risk. You have to put everything in operating. So if everything goes in operating, that's creating fluctuation in operating profit. Some companies do not like that, but that's what the standard says. There are new ideas coming up. There are more matters on this that has gone to IFRIC. Some companies are looking at revisiting the hedging strategy. Is net hedge the right way? Others are saying, no, this is an accounting issue. I won't, if I enter separate hedge, this would be so costly. So I'm not going there. So how do I take it forward? Aggregation, disaggregation, Sharon touched on it. Many companies, from my experience, leave it till the last, but it can have real considerations. It's thinking about what else do you need to disaggregate, how can you group what you have in there, but also what really goes on the face of the income statement, the primary statement versus the note. There's new guidance on that, and it's not as straightforward. Management defined performance measures. Again, that's one of the key changes. So there are lots of nuances. You have to identify those that are disclosing public communication. What's public communications to start with? Once you've identified your non-GAAP measures, which one of them meet those criteria to be management defined performance measures? And there are complexities. Once you identified which ones are your management performance measures, there are specific disclosures that need to be provided in the financial statements. And these require for reconciling, being reconciled to IFRS, but also for the reconciling the item to give the NCI and the tax impact. And this will be subject to audit. And this disaggregation principle apply throughout the financial statements. So it would also apply to your reconciliation of the management defined performance measures. I will again, there are several issues, but just we chose some of them just to bring to light that it may not be as easy. There are different things to consider and start early. That's the key message. But also, getting ready for IFRS 18 shouldn't be a one-time exercise. You would need to report on it going forward. So when you're thinking, you're assessing, you're making changes, how do you future-proof that? How do you future-proof it so that you have a process in place and the right controls so that every year it's easy to report under IFRS 18? And how do you leverage, if you're a big group, you have several impacted subsidiaries, if you're starting at the group level, how do you leverage what you're doing at group for the remaining entities? Yes, the impact for each entity will differ, but there's a lot that you can leverage. Lastly, if you're changing finance system, ERP system, definitely do an IFRS 18 impact assessment first. You wouldn't want to put through changes and then a few months down the line having to undo what you have done. So I guess in terms of summarizing it, there's a lot to think about. It may have significant changes on reporting, but other aspects. So start early, you have to restate comparative, and there isn't much time left. Just briefly, before I go on to this slide, just briefly touching on the impacts for insurance and banking. So insurance, because insurance companies have already or recently adopted IFRS 17, they've done a lot of work already. The main impacts we are seeing is where you have equity accounted investee and they are still policy holders of assets. But given IFRS 18 says it goes to investing, they have to go to investing. Others, which is maybe quite a bit rare for insurers, if they have investment property, as Sharon mentioned, that would go to investing. The maybe main impact that we are seeing is adjusted measures. So insurance companies tend to have a lot of adjusted measures and it's going through that and identifying which ones would be MPMs, management defined performance measures. And then there's the disaggregation principle. Yes, insurers, as any other IFRS reporter, would need to consider it. But what we are seeing is that because a lot of detailed work has been done for IFRS 17, insurers typically have the information that they need. And then just quickly on banking. So banking, similar themes. So some of what I've discussed in terms of the challenges would be applicable there. As Sharon mentioned, things would be classified in different categories, but some of the challenges still exist. We are seeing some banks having to rethink about the processes, control system they have in place to get the data that they need. And just to finish off on this slide, so this slide is saying we've talked a lot about the reporting impacts, the challenges, when do you need to report, start as soon as possible, but it doesn't stop there. We've also seen changes, impacts on management reporting, so forecasting. So if these are based on IFRS balances, IFRS reporting layout, when is that done? So then you would need to incorporate that in your timeline so that you're ready in time for those. So your budgeting normally is done well before the year in question. So when incorporate that in your IFRS 18 plan. Remuneration or in arrangements, covenants, where these are linked in some way to operating profit or an adjusted operating profit measure. If operating profit is changing because things are moving across the different categories, you have a new operating profit now, it's defined, we are seeing impact. And companies are stepping back and reassessing what does that really mean for them. Do they want to change what they have in place, or do they want to stay with it? Do they want to have another adjusted measure that takes out the effect of what's disrupting what they currently have? So again, consider that and do include these teams in your IFRS 18 project. That's quite key. So treasury systems, remuneration, investor relations, do include them from the outset so that they can start thinking about the impact. And I had a call a few weeks ago, and one of the person I was speaking to about IFRS 18, the first thing that he said was, oh, I'm going to renew my revolving credit facility and I have a covenant in there and I think it is operating profit, but let me check because I want to set it in the right way because I know IFRS 18 would be coming and that would cover the period that that covenant would be tested. Investor relations, listed companies, IFRS 18 is all driven by feedback from investors. So getting feedback from your investor relations, working through them throughout the journey, proactively if needed, getting feedback from the investor group, but also thinking, how do I communicate those changes? If you're listed, you potentially have interim accounts, but then do you want to, at that point, communicate the changes or beforehand? So when is that? Or do you have someone in place to manage that communication to investor group? And I understand tax and transfer pricing and system, our colleagues will cover that shortly, so I won't dwell on to that. Thank you for having me. I think I just wanted to share my experience, and my main message would be don't leave it till later. Look at it now, understand your impact. If you don't have much impact, that's good. You know, you can park it and then come to it later. But if you have impacts, then you can work through that so that you can start capturing the comparative data under IFRS 18. Thank you.
Great. Thank you very much, Nwanisha, for helping us with the experiences, and also Sharon for the overview. We've had a lot of probably new things, MPMs, classifications, calling other, being discouraged, and all that. But it's now 11 o'clock. We want to take just 5 minutes to stretch and have a go at the breakfast items at the back. We would resume immediately 5 minutes after so that we can go into the impact on systems, impact on tax. Then we can wrap it up with a question and answer. So you're welcome to enjoy the breakfast items. Those who have joined us virtually, we would encourage you to register your attendance using the link provided so that we can keep a track of the attendance and also keep the conversation going, because IFRS, the implementation of IFRS 18 is a journey, and we want to keep in touch as we see it to its end. So we take 5 minutes stretch, and we'll be back here at exactly 11:06 to begin. All right, thank you. All right, thank you very much. Is this up for those who are also virtual? I think we can go. Great, thank you. All right, so it's now time for us to hear out the tax perspective, and to help us with that, the implication of this new standard on the tax, we would invite our very own Kwesi Benyi. He has about a decade, over a decade, I should say, in the tax department. He's currently with the transfer pricing team, and he'll take us through the implications of this standard on taxes, especially transfer pricing, right? All right, so the next few minutes, we'll hear what he has for us, and then we keep the conversation going.
Thank you so much. So, as you are all thinking about the new standard, what you don't have to forget is that the Ghana Revenue Authority will also be thinking about the new standards. And when they are interested, you know where their interest lies. And we have to know the implications of using these new standards as well. The new standard requires that we, among other things, the management-driven performance measurement, we have to show a reconciliation. I recall Sharon made mention of that. A reconciliation of the tax, that's the operating profit, to the adjusted income, which we usually call the chargeable income. So you have to have a reconciliation of how you have your adjusted operating income and reconcile same to the operating profits. In our everyday income tax computation, we start with the profit before tax. If you add by depreciation, you deduct what you want to deduct, i.e. capital allowance and others, you arrive at your chargeable income. But this time round, what you usually have is, it will be the reverse. You have the adjusted chargeable income on top, and you reconcile same to the operating profit. What I'm saying will appear on the screen soon, so that you all align on that. What you have to bear in mind is that this time round, the standard requires us to have an idea or an estimate of whatever add backs or subtraction we are making to our operating profit. So, depending upon your income tax rate, I would, for simplicity's sake, I'll assume we are all doing 25%. Of course, some do more, some do less, depending upon where you find yourself. So, the standard requires that you give an indication of how much or the tax effect on each line you are adding back or subtracting. So this is where the catch lies. You will be reporting this in your financial statement. So whoever picks your financial statement, without even looking at your income tax computation, which you might have filed on your taxpayers portal, he will be in a position to see that this add back, it affected your tax by this much. Because the tax effect will be, let's say, 25% of what you are adding back or subtracting. So if you take the reconstruction cost, for example, 25% of that will mean the tax effect in this question will be 150 million. So the tax authorities, after picking up your financial statement and going to this note item, will have an idea of what you are doing to your profits or what you are doing to them. And once they are not happy with that, with this level of information, you know the implications. There will be disputes, they may disagree on the quantum, on the treatment, or whether it should be allowed or not. There are some things here that ordinarily, on the face of the Income Tax Act at 896, it should be allowed. But there is one section, which is the section 31, which borders on the transfer pricing, which has been expanded through the LI 2412. It gives the Commissioner General some powers to either disagree with you, although this is expressly provided for that you can deduct in the Income Tax Act. Let's take one or two things here that we can talk about. For example, if you should make a deduction that the commissioner is of the opinion that they are duplicated service. For example, you may have, as a multinational, you have an accounts department here, well-resourced with qualified people, and if in addition to that, you have your head office also providing some sort of accounting service to you. The GRA may disagree with you, and the purpose of their disagreement will be that it is mere duplicated service because they don't see the point why you have an accounting service, an accounting department here with qualified people. Why do you again procure accounting service from your head office? When that thing happens, then there will be some disagreement. So with this, what you have to bear in mind is that whatever you are adding back per this new standard, the GRA, just by checking your notes in the financial statements, they will have an idea of what you did to arrive at your chargeable income. This is more information to the GRA. So once they have more and easy information, they'll come back. So we should be prepared with the explanation, with the reasons, with the justifications why such deductions were made. Okay. Of course, what we have here will not affect, I don't know whether we have people here who work in the as petroleum subcontractors. For them, this will not have any bearing. What I mean is that the tax implication will have no bearing because of the 5% or 15% final withholding tax which they suffer. And this has been consolidated because of the MEX ruling. So if you are in that space, you are safe. So per this slide, only option 1 will apply in our jurisdiction because over here, you have to use the statutory tax rate. But the option 2 and 3 applies in other jurisdictions where they could be permitted to use a pro rata allocation to determine the tax effect. But in our jurisdiction, what will apply will be using your tax rate, which is commonly 25%, on the additions and subtractions you are making on your income tax computation. So what you have here is just a reverse of the income tax computation we usually do. The income tax computation, you usually start with this figure and end with the chargeable income, which we have named as the adjusted operating profit, because this is the requirement of the standard. So you have the information on your income tax computation, and you have it in the reverse form in your financial statement. And this will mean more information to the GRA. Let's move to the next slide. I have only 2 slides. Okay, so in this day and age, we are really familiar about the income tax computations, but the controversy lies with transfer pricing. And the sad bit is that it's so subjective, so subjective. So after you think you've assessed your tax liabilities and settled same, the GRA comes again, this time around, challenging the basis for some deductions you think were wholly, exclusively, and necessarily deducted. So before we proceed, let's bear in mind that we've made mention of certain things. We have agreement. You know, most related party transactions are governed with intercompany agreements. And the challenge that GRA has when they are reviewing this agreement is that, first and foremost, whether the agreement is at arm's length, that's one conversation. And there are instances where they will be interested to know whether what is in the agreement is what is actually being done on the ground. There are instances where people will agree something and do something different. I don't know whether it's out of convenience or something. But once they have your agreement and they look at your financial statements and they realize there is some discrepancy, they will always interpret it to their advantage. So in various instances where the numbers in the agreements are favorable, they'll stand with that. When the numbers that you actually, when the numbers or when what you do will favor them, they will stand with that. So the GRA, that's how they operate. So there should be consistency, bottom line, between what you say you will do in your agreement and what you're actually doing. When you give them some space, you are in trouble. And this time around, the reason why it will become easier for them is because of the granular nature of the new IFRS 18. They will have lots of information, so there should be some sort of consistency. Of course, we can talk about things like system and processes. Now, there are instances that GRA will be interested in you generating reports from your system. There are other people that they can even hook up into your system so that they will have a live demonstration of what you do. So if it should happen that there is some discrepancy between your system and what is being presented in the financial statement, the GRA can use the difference against you. This is quite important because there are some clients that at the end of the day, after they get reports from their system, they have to do a lot of adjustments before they arrive at the financial statement where they file with the GRA. So that's adjustment. What would be the justification? We are not saying adjustment, you don't have to do adjustment, but what would be the magnitude? And what would be the justification? What would be the defense and the rationalization for you to pass such adjustment so that what you reported to the GRA in your financial statement will be so different from what you find in the system? And what's the story behind the difference? Does it make sense? Will a reasonable man accept that, or will it be at arm's length? So we should have that in mind as we journey to this new accounting standard, because of the vast information that this new standard will arm the tax authority with. Also, in this instance, if you have any issue, where you have doubts, after seeking advice from your tax consultants, you can also, in order to mitigate our exposure, we can also ask for what we call private ruling. In our part of the world, although the law makes express provision for advanced pricing arrangements, it seems the GRA is not ready to do that. So, but what we have, which is somewhat akin to the advanced pricing arrangement, is what we call the private ruling, which we can go for with the GRA. When you go for the private ruling, it should really help you. It's binding on the commissioner, so they can't come back to arbitrarily assess you in a tax audit. So we can also have that in mind. So the standard that we have will ensure good comparability from year to year. Of course, GRA also, when they say comparability analysis in the transfer pricing, they have what it means. So they think comparability means comparing what you've done to what the arm's length standard should be after taking into consideration the resources you use. In this case, they talk about the assets used and the risks that you bear in that instance. So once they have this in your financial statement, they will come querying you. Lest I forget, one thing that is now happening in tax audits, transfer pricing audits, is what GRA usually requests, is when GRA usually requests for evidence of performance. So you might have gotten some management service from your related party. Indeed, and in fact, maybe it was helpful. But during an audit, what GRA requires from you is an evidence of performance, whether that service was actually performed. And invoices alone will not suffice. I'll be signaled that I have 1 minute, so let me wrap up. So as we are getting our management service, we have to document it. If there is a need for us to save some reports, show some minutes that we attended some meetings, if you have the credentials of the facilitators, in order to justify what you paid for, why you paid what you paid. Otherwise, in future, with this new coming standard, GRA may end up disallowing some expenses, and it will mean you paying taxes. The taxes are not painful, but the associated interest can be so much punitive. Ladies and gentlemen, I have to end here. Thank you so much. Nathaniel Ajintete, my friend and my senior high school, will take over.
Thank you very much, and thank you, our taxman. Just to repeat what he said, it's not the taxes that are painful to pay, but the interest that accrue on them for non-payment. I want to just leave you with 3 thoughts from systems, processes, and people perspective on this. Number 1, compliance with this standard begins before the preparation and presentation of the financial statement. Number 2, this standard is a very pervasive standard. And number 3, this standard will call for an assessment of your systems and your processes. So what do I mean by compliance is compliance precedes the preparation of the financial statements. If you realize one of the requirements of the standard is that in the first year of implementation, you have to revise your comparatives. If you want to do comparatives, you have to go back to your prior year and then present your prior results like what you are doing in the first year of implementation. So if the year of implementation is 2027, it means that your 2026 results, you have to present them in line with this standard. What it means is that as we sit in 2025, going to 2026, you need to factor the standard into whatever you are going to do in 2026. You must be able to look at how your numbers will look like in 2026 in line with this standard, because come 2027, you must do a comparative of your 2027 with your 2026. So really, implementation, if you want to think about it, is really imminent. Number 2, and thinking about it this way, the standard now brings 5 subtotals, categorization of your P&L items and all of that. You need to now go and look at your chart of accounts, whether your chart of accounts are scalable. You need to look at your system, the systems you have implemented, whether they are designed to structure the data that you are processing your transactions in line with these categorizations. So there is actually an impact assessment you need to carry out on your current ERP or your accounting software. The reason why we are talking about not just accounting software but ERP is that the various processes that will lead into your financial statements may not necessarily be sitting in your accounting software. All right, so you need to go back and look at other interrelated solutions that also feed data into your reporting and perform an impact assessment on them, whether the systems you have now can actually help you to do that kind of reporting. Because there's a lot of talk around, classification. Many of us accountants will be thinking, it's just a question of reclassifying something from one ledger item or one ledger code or one GL to another. It may not necessarily be like that. The standard intends to look at the nature of your business and reflect that in the way you report, bringing greater transparency and consistency across industries. So, for example, if you had subsidiaries take an interest, or an organization or an entity that has an interest in a financial institution and also has an interest in trading, all right? Because of the way we are categorizing transactions, so you have your operating, you have your investing lines, you have your financing lines, and so on and so forth. When you are consolidating, it becomes very seamless. Please, you understand? Because you have categorized them the same way, except that what goes into operations for a trading entity will be different from what goes into operations for a bank. However, the lines look very okay. I mean, because you've grouped the items very well. So it brings a lot of consistency and accuracy in the way transactions are grouped. And also, like Kwesi said, now it's also asking for a lot of disaggregation. So when you think of just reclassifying, maybe some ledger lines that you have may have to be broken down even further. Would your system allow for that kind of expansion? All right. So for me, these are the things we need to think about from a chart of accounts, a consolidation, a systems perspective, and controls as well. What controls are there are you going to put in place such that when somebody puts in a transaction and you review those journals are posted to the right classification? All right, it's very, very important. And even for consolidation purposes, would we need group policies around or group manuals that will support IFRS 18 implementation? So yes, it's about presentation, but it's actually transforming the way we record and we report. And we need to look at how this impacts our systems. So I guess that's what I will, in the interest of time, this is how I'll capture the thoughts. We all need to go back, look at our systems, and we are happy to have some conversations because for me, from where I sit, this standard brings a transformation in financial reporting, but then it will also have effects on the value chain. I mean, activities you do before you report, and we need to treat it with the urgency that it deserves. Thank you.
Thank you very much, Nat. Apart from being a close friend to Kwesi, he's actually a big man. He's an associate director with the Accounting Advisory Services. So if you have any big questions, please direct them to him. On that note, we have had a number of things to do with IFRS 18 and its implementation. We have seen the overview, the journey. We have seen the impact on the tax side. We have seen systems, processes. We are taking 5 to 10 minutes to discuss or raise questions from the audience, and then we would answer. So right about now, so for maybe 5 to 10 minutes, if there are questions, please feel free to bring them up. Those who have joined us virtually as well, you can put your questions in the chat box. We'll have someone coordinate that for us so that we can give you an answer. So are there any questions in the room so far from what we have heard? But before that, just so we can test the pulse, we have heard so many things. There's a QR code that is going to be posted or shown on the slides. Just give us an indication of how ready you think you are. Are you ready? Ben, if you can get that QR code, just so that we can have a feel of the room. How ready do you think you are as far as the implementation journey is concerned? Okay, just give it a minute or two. We'll see it show. So if you have your phones, you can just scan that when it's up. The same will be posted on the chats. Also, those who are online, if you have a question, you can raise up your hand and then. Okay, so those in the audience, we prefer you type your questions. Okay. All right, I see one person in attendance virtually, Nathaniel Appiah. Yes, you can go ahead with your question. The tech team, if you can unmute Nat. If you can unmute Nathaniel Appiah so that he would ask his question.
Good morning, and thank you for the presentation. So my background is I work with a non-governmental organization. So my question is, how does all this relate with reporting regarding non-governmental organizations,
Thank you.
grant organizations, non-governmental organizations?
Great. Thank you. We've noted that. We'll take a few more and then we would have an answer for you. If there are any more questions, we can keep them coming through the chats virtually. And those in the room, if you have questions, please feel free to alert us. There's one at the back. Let me just quickly get to you. Okay, there's a microphone here. No, it's fine. You can go first. Don't worry. Go ahead. Go ahead.
Okay. Thank you so much, KPMG, for such a wonderful program. In fact, when I was coming, I had in mind, this is very simple standard that is coming up for us to implement. I didn't know it is a very complex one. I think the time allocation is quite small. I don't know about my other CFOs, but I based on what I am seeing and the kind of preparation we have to do before the implementation, which is January 2027, I see the timeline to be quite too close. So the earlier we begin preparing, the better for us. When Malaysia was speaking, she mentioned about treatment of FX for intercompany transactions. I would like to know how about those that are not intercompany transactions, but based on the nature of their transactions, they have FS differences. How do we handle those ones? And I also see a lot of discretion in the treatment of the whole standard. I don't know whether it's only from my end. What exactly you have to go through to be able to identify that this particular transaction, I think, it should fall under operating, it should fall under financing, it should fall under investing. With the same thought that's going through your mind, somebody else is having the same thing and is falling under a different category. How do we ensure that we iron out those differences so that at the end of the day, everyone will present as expected? And the next question is, with that of MPM disclosures, is this solely disclosed only in the notes, or on the face of the financials, there is a portion where we have to do some form of computation and have it captured? My last one, Mr. Benny, I know CFOs have some level of tax understanding, but with what he said, if you haven't done tax, I bet you understand. You understand. So probably when we start breaking it down in learning how to be ready, we'll go into more details of the tax implication of the standard, and it will help us in preparing towards the implementation. Thank you. Sorry, my name is Eunice Edem Semoji Pogli, Association International School. Thank you.
Thank you very much for the questions. Indeed, many of them touch on very important or key areas of the standard. And as it is being implemented, of course, we expect a lot of the questions to come up like this so that it would enrich the discussion and help us also, at the end of the day, do the reporting as required by the standard. Let's see if, Manisha, if we could maybe take one or two of the questions regarding, the first one was on NGOs. What IFRS impact would they have as well?
Yes, sure. I don't know the local requirements, but IFRS 18 will impact any entities that prepare accounts in accordance with IFRS. So if you prepare your accounts in accordance with IFRS, you would need to consider it. I haven't dealt with NGOs specifically, and I presume there would be local regulations that apply, but it's similar considerations. Obviously, if you apply a different form of accounting framework, then you would need to assess whether IFRS 18 is being brought into that framework and then accordingly apply it.
Great. And there's also one on MPMs, whether they need to be disclosed only in the notes or also the face of the financial statements.
Yes, sure. So MPMs the requirement is for them to be disclosed in the note. So there are specific disclosures required in one note, one single note. You may choose voluntarily to present some adjusted measures, some MPMs on the face of income statement, but that will be voluntary. There's no requirement on the face. But if you choose to present it on the face, there are specific criteria you need to meet.
Thank you. Sorry, if you can repeat the question. FX. Okay.
Yes.
And then also the one on FX, right? Yeah.
Yes. So I touched on FX on intercompany balances that get eliminated at consolidated level, because that's a hot topic being discussed by the IFRS Interpretation Committee. But very, very quick question from the floor there. So FX, what the standard says, you categorize it in the same category as the income and expense related to the item that gave rise to the FX. It's a lot of words, I know. So what it means, in essence, if you have FX on trade receivable, your normal trading corporate company, you would put that in operating. You have FX on cash and cash equivalent, because the standard says income and expense from that goes to investing, you would put that in investing. If you have FX on loans, borrowings, and that's you're not a financial institution, that will go into financing. And the difficulties we are seeing in practice is that companies currently lump FX in one GL code. So they don't necessarily have the data. So they're going to have to see how do they get the data. Is it a change in the underlying treasury system? Is it a change in the finance system? Or is it just having more GL code? And then there are other complexities where you think about, so the standard gives an example. If you have FX on trade payables with extended credit terms. So if I think about trade payables with extended credit terms and I apply IFRS 18, ignore the FX for now. Trade payables is to do with your operating. The interest is to do with financing. Interest will go in financing. Your cost of buying the services would go in operating. Now you have FX on that whole balance, that trade payable that has an extended credit term. What the standard says is that you cannot split it between operating and financing. You use judgment and categorize that FX in just one category. So in that example, if the FX, your FX on your trade balance is largely to do with the trade balance, i.e. the cost of you buying that good, an argument could be operating is more relevant. Whereas in some instances, you're there so that you're making basically it's for financing purposes, then financing may be more relevant. So that applies to lease liability, to provisions, FX on provisions, pension liabilities, and others.
Great.
I hope I have answered the question, but I just wanted to give, it looks simple, but there are complexities around it as well.
Okay, that appears as a follow-up to that. So there isn't?
Answered, but in fact, her answer has made it more complex than I thought. It is not an easy thing, because just imagine I have FX on sales, on expense, and I have to break it down for, this is...
Maybe just to clarify, let's say you have FX on sales and purchases. You don't need to break it down into your revenue and cost of sale. You just need to put it in operating. So it's taking that FX and splitting it across the categories. IFRS 18 doesn't say anything about line items, but I still agree. It's some work involved.
Great. I see one more question in the room. Okay, there are two hands.
Richard Ahenkra Ose with Volta River Authority. My question is a little broad in terms of we talk about preparing for 2027, but we should take into account 2025, 2026 accounting. My specific question is relating to NOLs, which is net operating losses. And the benefit is sometimes for tax purposes, yes, we do have NOLs to help us realize gains at a later time. So my question is, how do you account for NOLs given the fact that we're getting to the IFRS 18?
Okay.
I can start, and then maybe someone else can add from a local perspective in tax. So, NOL, I presume now it's similar to your operating profit. And maybe just before I go to that particular question, you don't need to. So let's say you're December year end. Your first set of accounts that will be under IFRS 18 will be 2027. Unless you choose to early adopt, but let's assume you're not early adopting. But you would need to restate comparatives, so 2026. You don't need to change your 2025 numbers unless you present 2 years comparative. So it's only 2027, and if you present only 1 year comparatives, it's 2026. But you need to start now because it takes time, and if you want to be able to track your comparative already under IFRS 18, so that you have the relevant changes in place. Secondly, to answer your question, I'm not too familiar with net operating losses, but I presume what you're looking is a subtotal of income and expense. Now, you have to disclose operating profit. That could be an operating loss, but you have to disclose that. You can continue to present anything else, any other subtotal, on the income statement, but they have to meet specific criteria. Percy, I don't know if I answered your question, but if someone else, if it's more local net operating loss, commonly used subtotal, someone else, please lay on.
All right. So, Mr. Ahenkra, is your question answered, or do you need more clarity? Okay. Do we have any more questions in the room? Okay.
Okay, hi. My name is Barbara Aduna from Scancom PLC. My question is, the first one is on the MPMs. So are there specified or required MPMs at a minimum, or this is at the discretion of the company to decide which MPMs to disclose? So is it mandatory, or are they mandatory ones, or do we have the discretion? Because Scancom, we are listed, so we have other disclosures like EBITDA and all those that were on the face of the primary financial statements. So from what you are saying, this has to move to MPM or other disclosures, or how are we going to treat those? That's my first question. And the second one is, in line with the breaking of the structuring of the income statement to operating, investing, financing, does our cash flow statement have to align with this as well? Because in the past, you would have had like bank charges sitting under your other income. But now, from what you are saying, that should go under other investment income, which will be under investing. So when I come to my cash flow statement, do I have to align that treatment to bring that under cash flow, under investing activities, under the cash flow statements? So just a bit of clarity around that side.
Great. Sharon, or you? Yeah. All right, so Manisha can go first on the MPMs, okay, whether there are specific ones for, I'm sure you had a question, so you can go ahead. Yep.
Yes, so your first question is, do you need to have MPM? No. So what you need to do is, so let's say a company, so it's all about what your starting point is assessing the non-GAAP measures that you present outside of your financial statements. So looking at your public communication. So if you do not have any adjusted measures, that would be a subtotal of income, or would and represents management's view of performance of a business, then you do not need to have an MPM. So the exercise is look through all your public communications, which is outside your financial statements, identify all your non-GAAP measures. Of those, identify which ones meet the MPM criteria. And once they meet the MPM criteria, only then you need to include them in a note in the financial statements. What you disclose on the face of the income statement is your choice, but subject to certain criteria being met. So that's your first question. Your second question, very good question. Cash flow statement, income statement, call the same categories, are they aligned? The answer is no. Confusingly, I don't know why, because someone would think they are the same categories, but the answer is no. So an example, take a normal trading company. I have sold a PPE, property, plant and equipment. That proceeds from the sale of the PPE would go in investing category in the cash flow statement. But that gain or loss on the PPE, because it's part of my operation, it will go into operating. So while they are called the same, different rules apply. There is a cash flow project currently underway by the IASB because of the lack of guidance and etc. But I don't know where that would land, whether it will achieve consistency. So it's very early stage. To go back to your question about cash income, interest income. So what IFRS 18 has changed, that's the main change what Sharon talked about, there has been some consequential amendments to IAS 7, so your cash flow statement standard. And what it says, if you take a normal corporate, currently there's flexibility as to where you present dividend and interest cash flows. That flexibility is going away. So for example, interest income, companies could present it in operating or investing. That's going away. But it's not going in a way to achieve alignment with income statement.
Very
so
good.
different rules apply, you follow the different rules.
Great. I think that would answer that. But just to mention, we advertised that we would end at 11:30. It's now 11:48. In fact, 50. We're heading towards noon. I think we can have the questions come in. We still have some lunch items at the back. We can do a little bit of the networking, and then we can ask a few of the questions right here and have them answered while we wrap up. Okay, so we'll pause the question and answer just for a bit, and then introduce the next on the agenda so that we can manage the time. If you'll indulge, please. Thank you. So we would have Sharon Akwe come again to take us through what the call to action is now. We see that a lot of questions are coming in, and it's good, especially now that we are thinking of implementing this. In fact, we have to comply. Come 2027. We will have to comply. So the conversation will still keep going on, and we will still be in touch with you to ensure that we meet ourselves in the conversation and satisfy the standard that is coming up. So in the next few minutes, Sharon will just give us it's like a timeline of what the expectation is until the required date, and then how KPMG can assist. Sharon.
All right, thank you very much. And thank you for the questions that came in. There was a comment that this looks more complex than it actually is or appears. And I think that's the reason why KPMG is here to also assist you if you need the help. Okay, so I'd like to quickly take us through how the roadmap looks like. We all know now that the standard is effective 1st January 2027, and our comparison, which is 2026, from now we should also try and start aligning how our classifications will be to make sure that we are compliant by that date. So briefly, just to run you through a roadmap on the key things that you need to make sure that you've done before the 1st of January 2027. So first of all, if there's a need, you can put together a project team, okay, to start with a project team who would focus on how they would implement this change. Okay, secondly, you would have to perform an impact assessment, looking at how you currently do your financial reporting, and then what the impact will be when IFRS 18 comes in on reporting, on your systems, on your processes and controls. You need to take your time from now till the end of next year to perform this impact, well, let's say to the middle of next year, to perform this impact assessment, and then after that, execute the results from your impact assessment, which is going to help you make sure that you are aligned when it comes to IFRS 18. Aside that, you'd also have to put together your accounting policy based on the IFRS 18. And then at the end of it, so by the end of next year, these things should have been done, and then you should have been able to align your financial reporting processes, systems, and controls to the new standard by the end of next year. And at that point, you would now have to communicate to all stakeholders. So investors, any other person who is interested in your financial statements, you'd have to do that communication to them on the change and how this is impacting your financial statements, and also train staff to be very conversant with the standard. Okay, so in summary, this is how your roadmap should look like. Yeah, if you need any help, we are available to assist you with that. And there are a number of ways by which KPMG can assist. One is by providing training. So we have a team that can take you through IFRS training, not only on the IFRS 18, but on any other finance-related training. We can also assist with the accounting impact assessment. Okay, so for instance, with the IFRS 18, the change that is coming in, we can assist you perform the assessment to see how the new standard is going to impact your current financial reporting and systems. And then if there's a need for probably you have some financial data that you usually report to your regulatory bodies, KPMG can also assist with that. And there's also an on-call accounting service. So for that, it's usually a retainer service where you can sign up to, and at any point in time, if you have any technical accounting issue, you could send us an email, give us a call, and then we would take our time and respond to the issue to help you resolve that. And also, we can assist with the conversion. So if we can work hand in hand with you on any conversion, like for instance, the IFRS 18, can assist you to convert, make sure that you've converted your financial statements correctly as is required by the standard. So I think that brings me to the end of what is required on the call to action. Ebenezer, I think I would hand over to you now. We are available during the networking session for more interactions. We would also be reaching out to you, coming to see you individually at different times from now till next year to see how you are faring with the conversion. Okay, thank you very much.
Thank you, Sharon. So thank you very much for taking us through. I was very interested in when I saw the on-call service. I didn't know KPMG had started doing medical services, but so we are on call. That's what it means. All right. I think that's a very interesting service line to have. So, which means it will be available to you whenever you call. All right. So that's it for the entire session. The questions that we have with us, please don't take them away. During the final parts, after we are done here, we are still around to to interact. So the questions, we can still take them and then provide insights as may be required. Those online as well, please keep posting your questions. We will have someone respond to you. And so for that, to make that easier for us, we posted a link for you to register. That'll be a very good way for us to get back to you with the answers that you need. Great. Right about this point, we will take the closing remarks from our partner in the name of Joycelyn Coleman to set to close the curtains for us. So Joycelyn, you have the floor.
Thank you very much. Thank you to all of you who managed to make it. We have a lot of people online, and we specifically asked for some of you to also be present. So we're really grateful that you did make it here this morning. The questions are coming fast and furious, and as Eunice said, it's even made it, as opposed to making it clearer, it appears that it's made it even more complicated, but it's good. When half the solution to a problem is knowing that you have a problem, and then looking at the steps to be able to address it. So quickly, thank you all very much for being here. Thank you, Manisha, for being online. Thank you to all of my colleagues who put this program together. I think Sharon's made it very clear, the call to action, making yourself ready, making our people ready, as Nat said, getting our systems ready, getting our processes in place to be able to address all that is required for us to do. As Sharon said, we're available. Let's let the questions flow, the interactions, and even keep the relationship so that if you need any assistance, you can always come to us. So we're very grateful indeed. Thank you to everyone for being here. As Eben said, or even as I said before during the previous break, we have lunch at the back there. So make sure that you finish everything before you leave here. It's Friday. I'm sure you can go straight home and have a nap. So thank you all very much indeed. And on that note, I hand over to Eben to close completely. Thank you.
I'm not so sure about going back to nap, right? I wish. But as you can see on the slide, we have one more form for you to fill for us. Just give us an evaluation. How did you feel? Did you feel that this was worth your time? Would you attend in future sessions? Should we organize something like this? Let us know. You can scan and then give us your feedback. Also, those online, I'm sure this will be posted for you. You can give us your feedback. What went well? What didn't? How can we improve so that we can have a good session the next time we have this? Thank you very much. There's more jollof at the back.